Welcome to TheoTrade. This is Don Kaufman. Here we are. It is January 25th, 2017. You were watching the Theo Night video. We just have moments left in the trading session with the S&Ps once again exploding to the upside in fairly wild fashion over here. That is right. The S&P futures specifically are closing, it's hard to believe, just shy of 2,300, given the fact that earlier this week, again, we were trading in and around the 2,260 range. So once again, we see this lack of movement for literally weeks at a time, followed by what we'll consider this, okay, a 3 standard deviation move. Now, before we get ahead of ourselves, again, the week is far from over. Here we are on Wednesday. We've had, again, 2 utterly explosive moves to the upside. Both days, ranges have exceeded 20 handles. That's 20 points on the S&Ps. Okay. Ironically, the number one email that I'm getting right now, it's not even about like individual stocks. It's not so much even about the Dow at 20,000. Okay, like, you know, people mention Dow 20,000. That happened at the cash open of today's marketplace over there, neither here nor there. But the number one email, and I've really gotten flooded with them specifically today. How do I protect my downside? And again, I'll give credit where credit's due. I like the way the people are thinking over here, you know, being a little bit more protection than looking to jump on what has become, again, just an explosive move to the upside. Now, people are always going to comment on this front and simply say, well, you know, it's short squeeze. Listen, it doesn't matter what you think. There's actually the closing bell. It doesn't matter what you think per se about this particular rally, whether it was a short squeeze or not, is neither here nor there. The bottom line is the S&Ps themselves, this is the SPX, are closing just shy of 2,300. So, as I said, the number one question that we're getting right now is, how do I protect my downside? Well, there's a couple of ways. First and foremost, you know, we had done a class back in September called the Risk Twist Spread. And ultimately what that class was a class designed to build trades either in the spiders, okay, or the SPX to control downside risk, a type of a ratio spread. But moreover, if you've got an entire portfolio, how you could mitigate or control a degree of the risk could be using these S&P futures. Now, more often than not, people use S&P futures. Okay, whether you understand the product, whether you have any intention whatsoever about ever trading a futures contract, just bear with me as I kind of explain this a little bit. The S&P futures contract was initially designed to mitigate risk. I mean, that's what the Chicago Mercantile Exchange was all about, you know, laying off risk. And then people started trading, of course, the S&P futures on an intraday basis over here. Hopefully, if you traded the S&P futures today, you were long, not short. Nevertheless, the contract itself can be a great risk mitigation tool, and allow me to explain. So you may have a 401k. You may have an IRA. And many of you, if you have a 401k, all right, it's in some mutual fund, and you recognize it's like, you know, arm's length away. Like the 401k is obscure. It's like you can barely touch it out there. But you might have some fund that could be sustaining huge risk. I mean, it's a great time to talk about risk when the market's, it's an all-time high. Everybody, you would think that everybody was getting euphoric and they're like, wow, I got to jump on this rally over here. But again, the irony is that people are emailing me worried about the downside. We received, okay, and actually were flooded with those emails today and questions in our chat room. So if you look at the S&Ps, as they're at the all-time high, and I'm just going to close up this left side bar right now. You're taking a look at the S&Ps. If you've never traded a futures contract, recognize this. One E-mini S&P 500 futures contract, because again, I know you can't touch the 401k, but you can trade a futures contract in any regular brokerage account. So what you could ultimately do is, again, granted your 401k is isolated. In fact, I'll kind of sketch it out for you over here. Here happens to be your 401k. It's isolated, right? It's in little bubble land over there. And you may have value in that 400k. I mean, listen, I don't know. You could have $200,000 in the 401k. Some of you could have $1 million in your 401k. Others, $50,000. It's just, again, everybody's different. So I like this. It's a 401k worth $200k. But it's a 401k that's in a little bubble world. Or you have some IRA over here. Again, It's on a little bubble. Maybe it's got $50,000, maybe not. Okay, this doesn't necessarily pertain to everybody. And then you have your regular brokerage account. Here's your regular brokerage account. So, and this is, we could call this a Reg T account. Regulation T is just a regular margin account, so that's a Reg T account. And yeah, listen, you may only have $20,000 in there, but you can trade, all right, a futures contract over in this account to mitigate the risk of your 401k or to mitigate the risk of your IRA. This is done all the time by hedge fund managers and so forth. They use one account against another. Nevertheless, if you're unaware, okay, why people might use a futures contract, control their risk, is I'll click this drop-down menu, come over here to futures. First of all, the futures, the overnight margin is $5,225. $5,225. Okay, and what one futures contract amounts to is the equivalency, okay, of being long or short 500 shares of the spiders. So what are the spiders? The S&P 500. So let's go back over again to the futures contract that we have over here. So here's the S&P futures contract, and you're like, well, again, Don, I don't get it. Well, here's what we're going to explain. So once again, here's that 401k, and it's a bubble, okay? And that 401k has some mutual fund in it, or it has some ETF product in it. And that fund or that ETF probably has an extremely heavy relationship to the S&P 500, right? Heavy relationship to the S&P 500. Maybe it doesn't have a relationship. Maybe instead of a relationship to the S&P 500, some of you may have a fund that has a relationship to something like the Russell product. Nevertheless, there's an S&P future, there's a Russell future. I always explain it with the S&P future. So what we could do is if this account, let's say this account once again is worth about $200,000, we could go out and we could sell one contract, okay, of this ES future. One contract to the ES future is going to mitigate or control a vast amount, okay, of that $200,000 of risk. Listen, it's not going to control all the downside of the risk over there, but it is going to control a substantial amount. If you're curious as to what a futures contract is ultimately worth, a 1-point move in this futures contract, again, I've got my trusted calculator open over here. Let's just put the futures, okay, at about 2,300. I know it's hard to put them up that high, but that's what they're trading for. The futures contract is roughly worth $2,300. And a 1-point move in futures, you would make or lose $50. So just take $2,300, multiply it, okay, by $50, and what do you get? One E-mini futures contract is worth $115,000. Okay? It's worth $115,000. Now, that's, again, it's not dissimilar to if you bought or sold, 500 shares of the spiders. If you look at the spiders, okay, the spiders are what? A $230 product. They're a $230 product. You go out and you trade, okay, 500 shares of that. What does it equal? It's $115,000. There's really no difference. Well, here's the difference. If you go out and you buy or sell, okay, 500 shares of the spiders, how much margin are they going to tie up? They're going to tie up in a Reg T account, like I just said a moment ago, they're going to tie up half of the $115,000. So do some math really quick. You're like, boop, 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 boop. You're like, that's a lot of money. Yeah, it's like $57,000. $57,500 is what they're going to tie up in margin in that particular case. So if you're going to mitigate risk and you're looking to control that risk, why use the S&P futures when or why use the spiders when you can use an S&P future? Because an S&P future, whether you buy it, whether you sell it over there, again, it's going to tie up substantially less margin. I mean, let me ask you this. Would you rather have, $57,000 tied up overnight or $5,000 tied up overnight? So the S&P futures are really, in my estimation, the best answer to risk mitigation. And this is something we're talking about just extensively right now here at TheoTrade on a day-to-day basis. Obviously, it's on the minds of many, many traders, okay? But this isn't about trading. This is about actually protecting some of your longer duration investments. Again, markets tonight, all-time high pretty much across the board, no matter where you want to look. Whether you look at the S&Ps, which are approaching rapidly the 2300, the NASDAQ all-time high, the Dow all-time high. Listen, the Russell, okay, there you got me. The Russell is not necessarily at an all-time high, but hey, give or take a few points, it's really, really close to an all-time high over there. The Russell is the only marketplace that pretty much on the screen that is not at the all-time high. With that volatility crushed down, I mean, to say that volatility is suppressed is an understatement. That is correct. Ladies and gentlemen, the VIX tonight closing, okay, in the 1080 handle. Cruising down to the bottom of the screen over here, you even have the VVIX, the volatility index, at 78. Again, I think this is a wonderful time at all-time highs to talk about risk mitigation. You have questions on this front? Feel free, reach out to us, support TheoTrade.com. My name is Don Kaufman. Have a wonderful evening, everybody. Bye-bye.